You know those mornings when the budget news hits and suddenly every trucking WhatsApp group starts buzzing? That happened recently. The announcement says that CRA is being given special funding for a brand new pilot project, a project focused specifically on the trucking sector and especially on situations where a driver operates through their own corporation. Not only that, CRA is now being empowered to share information directly with ESDC, which means penalties for employee misclassification can be issued much faster and with far more accuracy than before. It feels like something huge is shifting. And to understand why this moment matters, let me take you into one of the most fascinating stories in Canadian tax history. A real case that involved not one company, not two, but 36 incorporated drivers, all audited at the same time. Hi, my name is Amandeep Singh, CPA and founder of Cloudiverse CPAs in Burnaby. I help small business owners understand CRA rules in a simple and relatable way, and I want this story to feel like you're right here with me as it unfolds. Because what happened inside this case explains exactly why the budget announcement feels so significant. So let's go back in time to Berthierville, Quebec. In the 1990s, a large regional waste collection company called EBI ran its operations like many trucking businesses do. Employees driving company trucks, performing daily routes, taking instructions from dispatch. But in 1995, everything changed. EBI invited some of its most reliable drivers into a new structure. They were encouraged to incorporate small companies, numbered Quebec corporations, and instead of being employees, they would perform the same work as independent contractors. And this was not a small experiment. Over time, 36 corporations were created this way. Each company belonged to a single driver. Each company signed an almost identical contract. Each driver used EBI's truck, and each driver worked the same routes they worked as employees. Each driver parked at the same yard, each driver delivered logs to the same dispatch office, and every corporation had the same customer, EBI. This structure ran for close to 13 years, and from the outside it seemed smooth and efficient. But then came the CRA review. When CRA looked at the system, the key question they asked was simple. If the corporation did not exist, what would this relationship look like? And to answer that question, they went deep. EBI's arrangements with the drivers showed a carefully coordinated system. Drivers arrived early morning at the yard, they picked up EBI-owned trucks that had to be serviced at EBI-approved garages. They followed daily instructions from dispatch. They submitted detailed activity logs. They had no ability to take on other clients. And when they took vacation, they were replaced by workers from an internal EBI pool. Some drivers worked alone, some managed routes requiring an assistant, but in every case, the administrative backbone, which is bookkeeping, tax returns, routing schedules, fuel reimbursements, insurance, all flowed through systems tied back to EBI. One detail stood out clearly. Many of these drivers had been EBI employees before incorporation, and when the structure collapsed years later, most of them went back to being EBI employees, driving the same trucks on the same routes. So for CRA, this pattern mattered. And when the facts were placed before the court, the analysis became very thorough. The court examined the relationship closely. One major insight came from the trucks themselves. The drivers' corporation did not own them. EBI retained complete ownership, insurance, repair control, fuel requirements, and even dictated where the trucks were to be parked. Any breakdown meant EBI's equipment had to be used. The drivers were not free to choose an alternative method to perform their work. Another detail the code highlighted was the deep integration with EBI's daily operations. The drivers followed EBI's schedules, took instructions, completed EBI's logs, and worked exclusively for EBI. The contract even said drivers could only be replaced with EBI's consent. These elements showed a relationship that looked far closer to employment than to an independent business. And this is where the code applied the legal test. Would the individuals have been employees if the corporation did not exist? After reviewing all the evidence, the operations, the supervision, the limited autonomy, and the fact that many drivers resumed employee status after the structure ended, the court concluded that these corporations were personal services businesses. And once that conclusion is reached, the tax consequences follow immediately. So, what actually happens when CRA calls your company a personal services business? The corporation pays tax at a much higher rate because the small business deduction is denied. Deductions that normal businesses can claim became restricted, and the corporation is treated as a vehicle that essentially channels employment income. For trucking businesses, where fuel, repairs, maintenance, insurance, and equipment costs form a large portion of the expenses, this can dramatically increase the tax bill. Even voluntary disclosure only helps with penalties and interest. It does not change the fundamental tax treatment here. This is why PSB assessments feel so overwhelming for incorporated drivers. Now, remember, this case involved 36 companies at once, not just one, not just two, an entire system examined together. And that is what makes today's budget announcement so powerful. Today, CRA receives funding to launch a pilot project focusing directly on reporting of trucking service payments, personal services business enforcement, and coordinated action in ESDC with ESDC on worker classification. When you combine that with the approach CRA took in the Quebec case, the message becomes clearer. Trucking businesses benefit significantly from planning before problems arise. At Cloudiverse CPAs in Burnaby, our team helps businesses understand their structure, documentation, contracts, and tax risks. I often say that we try to act like Google Maps for corporate tax, guiding you around the confusing routes before you hit an experienced and unexpected roadblock. With the new enforcement focus, these issues have become far more important. The story of the 36 Quebec corporations is a reminder of what CRA looks for. It shows how they evaluate real-life work arrangements, how they assess control, integration, autonomy, and risk, and how long running structures can be reviewed even years later. And today's budget announcement shows that the trucking sector is moving into a period of increased attention. If your business operates in this space, whether you're incorporated as a single driver, running a fleet, or subcontracting, this is the moment to review your structure, your contracts, your operations, and your CRA readiness. Planning ahead always creates the best outcomes. Thanks for watching, and I'll see you in my next video. Until then, bye.